Hi, everyone. It's the last PowerPoint, so we're happy about that. We're going to try to get through chapter 13 in 15 minutes. So that's macroeconomics in 15 minutes. Not bad. So macroeconomics is talks about the money supply. And I think that's kind of interesting, statement the book says money is perhaps the most important invention created by humans. Imagine if you had to barter for everything. So you had to trade for things like your food or your clothing. You have to provide something to get something. So instead, today, we have money. So that's kind of one of the major concepts in macroeconomics. So money is a medium of exchange. Obviously, you go to a store, you buy things. Money is used to assess profitability, look at how businesses budget their finances. And then money, of course, is like money in the bank. It's the most liquid of all assets, meaning that you can use it instantly and it holds its value, especially in the United States. This is kind of interesting slide, just real quick. It shows the Federal Reserve districts. They're kind of in a darker area line. Your book shows this probably a little bit better than this slide does. And there's a question, I think, on your homework for that. So in terms of the money supply, the Federal Reserve, the Fed, is the big bank. And the Federal Reserve basically, if you want to think of a bank, storing money, that's what the Federal Reserve does. And remember, in the US, we no longer have a gold-backed currency. But the Fed basically has the mint where they print money. There's many Federal Reserve banks. The headquarters, of course, is in Washington, D.C. And there's some good movies about this. I'm sure you guys could think of some of the movies where they're robbing the Federal Reserve and stuff like that. But anyway, so the Federal Reserve is a big store of money, and they loan money to banks. So that is one of the major purposes of the Fed is to lend to your, local bank that you go to. And then the other thing is the big real function in the economy is to regulate the money supply. So the Fed basically makes policies that require banks to have a certain amount of deposits on reserves. So when you deposit your paycheck, you go there and you can take money out, and the bank has money for you. The Federal Reserve sets the discount rate. This term is important. The discount rate means that's the interest rate. So the Federal Reserve sets the rate at which banks borrow money from the Federal Reserve. Yes, banks borrow from the Federal Reserve and then they loan it to, businesses. The Federal Reserve is tied into bonds, and that's basically how you sell bonds to be able to print more money. And then if you remember President Obama, he did the whole idea of quantitative easing during the economic crisis, and that had to do with buying mortgage-backed securities. So those were the houses that people had defaulted on, and that was kind of a new term at the time. So one of the things that when we talk about monetary policy, there's two types of monetary policy. There's expansionary monetary policy and contractionary monetary policy. Expansionary monetary policy, remember this has to do with interest rates and the government's supply of money. So expansionary government policy, monetary policy, basically expands the amount of money in the economy. And the way that the government does that is by lowering interest rates, lowering the reserve that banks have to have available. Contractionary monetary supply, on the other hand, is when we usually do that when inflation starts to get out of hand. And that's when we raise interest rates, so you make money more expensive, and you decrease the money supply in the economy. Okay. I don't know. This slide to me isn't that important. It talks about how banks loan money. So I'm going to kind of skip over this. Assuming you kind of understand that the way that banks make money is by charging an interest rate. So the interest rate is the price of money. So when you borrow money to buy a car and the interest rate is 3%, that 3% is how the bank makes money loaning money. So this is an example of the two types of policy changes that the federal government can do. And we're kind of right now, our economy is in this expansionary phase, and it's been in that way for quite a long time. So basically, interest rates have declined. They're kind of hitting bottom now, and they're starting to come up a little bit. And the Federal Reserve lowers the amount of money that banks have to keep on supply. Contractionary policy is when interest rates rise, banks have to keep more money on reserve, and contractionary policy typically happens when the economy is moving too fast, the price of things is going up too high, and the way that you understand it is when inflation starts to become an issue. So the demand for money, basically, it's kind of like a little separate topic. When would you need money? Well, obviously to pay for your normal business expenditures, to cover unexpected expenditures, or maybe to invest in something like the stock market, or maybe you can invest in a horse and, have a horse for a horse race or something. So those are three ways that you and investors and businesses would demand money. Okay, this slide talks about market equilibrium in money, and you might not think about that too much, but if we look at this, the demand for money is just like a regular demand line, and the price of money is the interest rate. So the higher the interest rate, the lower the quantity of money in the economy. The lower the interest rate, the more people demand money. And it's not maybe you as an individual consumer, but it's businesses. Because remember, if a business wants to expand, then a low interest rate means over the course of that loan, like 20 years or 15 years, they're going to pay back thousands of dollars less in interest if interest rates are low. So where money demand and money supply meet, that is money market equilibrium, and that is where interest rates are established. So another aspect of macroeconomics is fiscal policy. Monetary policy has to do with the government printing money and interest rates. Fiscal policy has to do with taxation. So fiscal policy is taxes. And if you remember way back in chapter 1, I think we talked about monetary and fiscal policy. So there's two types of fiscal policy your book talks about. Automatic fiscal policy instruments is basically taxing that takes place over time. So it's like a progressively increasing tax rate. The example I can give you here is for those of you that own property. Your property taxes can only increase thanks to Prop 13 1.5 million years ago, back in the 1970s. Your property tax can only increase by a very small percentage each year. So that is an example of an automatic fiscal policy, is how your property taxes increase. Discretionary fiscal policy instruments basically is when Congress makes a law to change tax law. And since President Trump's been in office, there have been some very interesting changes in income tax policy. So that would be discretionary fiscal policy. So I like this slide. This slide shows, and hopefully my face here isn't covering up everything. This slide shows receipts, which is money coming into the government. How does the government make money? By taxes. So when you pay taxes, that money goes to the government. It pays for your education, it pays for roads, it pays for, a lot of things that we pretty much take for granted. So receipts is money coming in, expenditures is money going out. And it's very interesting that since about 2009, which is where we had, the economic huge recession, expenditures have outweighed receipts dramatically during that very difficult time in our, historically in society. And since then, the gap has closed a little bit, but that is basically what's deficit spending. So you're spending more money than you're making. And that's unsustainable just from a practical standpoint. Okay, so let's go back to this idea of fiscal policy action. So that's taxation. Fiscal policy is taxes. So expansionary fiscal policy is when we cut taxes, and when you cut taxes, that increases consumers' disposable income. Okay, when consumers get more disposable income, they keep the big wheel rolling. Remember, 70% of the economy is driven by consumer spending. So when you cut taxes, consumers buy more stuff. Expansionary fiscal policy generally means that the government is going to do more things. Increase in government spending basically means military expansion, expansion in education, things that the government, expansion of entitlement programs like Social Security, things like that. When the government increases that, then that serves to increase aggregate demand. Aggregate demand is the demand for all goods and services. Because if you increase government spending in the military is going to buy more things. They're gonna, expand the number of their labor force in the terms of recruitment. So that's the effect of expansionary fiscal policy. Expansionary, cut taxes, increases disposable income, increase government spending. That typically increases aggregate demand. Contractionary fiscal policy increases taxes, you decrease disposable income. Nobody wants to do that. That's bad politics. Cutting government spending, that's always amazingly difficult. And that decreases aggregate demand. So both of those things have impacts on the economy. And one of the big things we're always looking in the economy is we don't want inflation to take away the value of the dollar. So that is one of the things that the Federal Reserve does, is determines taxes and also is the money supply. So these are just a couple little graphs. Some of you need to look at supply and demand graphs. So this is basically tax revenue, money coming in. So contractionary fiscal policy means basically you are increasing income tax collected, so that is going to that's going to decrease amount of money consumers have, whereas it's going to have an effect of shifting tax revenue to the left, right? Less taxes. Okay, and that's what they're showing by the arrow for expansionary fiscal policy. This has to do with the budget deficit, and basically is showing you that if you have expansionary fiscal policy and you continue to spend more than you reserve, the budget deficit is going to increase. Okay, and there's an interesting part in your book if you want to read more about the federal deficit. The authors of your book are from Texas, they're very conservative, and some of the things that they say are very interesting from an economic standpoint. So if you want to go back and look at this, it's expanded upon a little bit more. I'm not going to talk too much about it. But the national debt is basically the difference between the receipts the federal government takes in and the money that the government gives out. That creates debt, and deficit is the amount of money that we're spending over what we're bringing in. Okay, one of the ways the federal government creates money is to issue bonds, and the U.S. Treasury issues bonds. The Federal Reserve is behind that, and basically what that does is create a greater money supply, and that is interesting because anyone can buy government bonds. You don't have to be a U.S. citizen. Other countries can buy American T-bills. So, okay, and if you want to read through these concepts, these are the main concepts of the chapter. I think there's a couple, 9 of them or so. Anyway, so it's been a great semester, and I've enjoyed kind of getting to know you guys. It's always hard in an online class, but that's about all the time I have for this chapter. So we'll talk more later. Goodbye.